Welcome to Session 3 of Market Risk Management. In the previous sessions, we focused on understanding market risk and how it is measured, monitored, and controlled within banks and financial institutions. In this session, we move one step further, from measuring risk to actively managing and mitigating it. We will discuss hedging techniques, the derivative instruments used by banks, and practical case studies that show how hedging decisions are made in real market conditions. By the end of the session, you should be able to understand why hedging is used, how instruments are selected, and how risks are managed in practice, not just in theory. Before we begin Session 3, let's quickly recap what we covered in Session 2. We discussed the key components of market risk, including interest rate, foreign exchange, equity, and commodity risks. We then looked at market risk measurement tools such as sensitivity measures, value at risk, and stress testing, and how banks quantify potential losses. We also covered risk limits, monitoring, and governance, highlighting the importance of independent risk oversight and timely escalation. The key takeaway from Session 2 was this: risk cannot be predicted with certainty, but it can be controlled through discipline and strong frameworks. This naturally leads us to Session 3, where we shift our focus from measuring risk to actively managing and hedging it. In this session, we focus on how banks actively manage market risk through hedging. We will begin by understanding why hedging is required and how it helps institutions reduce volatility and protect capital. Next, we will look at the hedging instruments used by banks, including derivative products commonly applied to manage different types of market risk. We will then walk through the hedging process and the discipline required, from identifying exposure to monitoring hedge performance. We will also discuss hedge effectiveness and testing, which are essential to ensure that hedges are actually working as intended. Finally, we will tie everything together through real banking case studies, showing how hedging decisions are made in practical, real-world situations. Hedging is a core risk management activity for banks and financial institutions. The primary purpose of hedging is to reduce earnings volatility. By offsetting adverse market movements, institutions avoid sudden swings in profit and loss. Hedging also helps protect capital by limiting the impact of unfavorable price movements on the balance sheet. Another key objective is to stabilize cash flows, especially when future inflows and outflows are exposed to interest rate or foreign exchange risk. Finally, effective hedging supports regulatory expectations, as regulators expect banks to actively manage and mitigate market risks rather than simply measure them. It is important to remember one key point: hedging is not speculation. The goal is risk reduction, not profit generation. Hedging is simply about reducing risk by taking an offsetting position. When an institution is exposed to potential losses from an adverse market movement, it takes an opposite position that gains when the original exposure loses value. The objective is to offset adverse price movements so that losses in one position are partially or fully balanced by gains in another. It is important to understand